Accounts payable is a short-term credit suppliers provide the company for paying for the goods supplied to the company. Accounts payable is listed in the current liability section of the balance sheet. Accounts payable ratio is a measure used to quantify how sooner or later the company pays the suppliers. It is also a measure used to quantify how many times in a given period the company pays the supplier. Accounts payable turnover ratio is equal to cost of goods purchased divided by average accounts payable. Cost of goods purchased is the price at which the goods were sold by the supplier to the company. The average accounts payable is equal to starting accounts payable plus ending accounts payable divided by 2. Decreasing accounts payable turnover ratio indicates a company is taking longer than before to pay off its suppliers. It could indicate that a company is in financial distress. A decreasing ratio could also indicate that the company has negotiated a different payment arrangement with the suppliers. It could also mean that the number of suppliers for the goods have increased over time, due to which the company could have made an arrangement with another supplier who had agreed to better payment arrangement than the previous supplier. Increasing accounts payable turnover ratio indicates a company is paying off its suppliers sooner than before. It could indicate that a company's cash flow is increasing and its financial condition is becoming better than before. It could also mean the company is not reinvesting its cash into its business and rather pays the supplier sooner than before with unused cash. Increasing ratio could also indicate that the supplier has negotiated a different payment arrangement with the company. It could also mean that the number of suppliers for the goods have decreased over time and the existing supplier could have become a monopoly and therefore could have negotiated a different arrangement with the company which is better for the supplier than before. Accounts payable turnover ratio of the company should be compared with the sector accounts payable turnover ratio or with the accounts payable turnover ratio of similar companies in the sector. If the ratio is lower than the ratio of similar companies in the sector, the company might have better bargaining power than other companies in the sector. Or it could mean the company is financially distressed than the other companies in the sector. If the ratio is higher than the ratio of similar companies in the sector, the company may not be reinvesting cash into its business unlike the other similar companies, and rather it pays the suppliers sooner with it. Or it could mean that the company has less bargaining power than other companies in the sector. In a nutshell, as with all ratios, accounts payable turnover ratio should not be taken at face value and should be rather investigated further to find out the reason for a high or low ratio compared to similar companies in the sector. Demo. There is a company which starts with equity capital of 2 lakhs and debt capital of 3 lakhs on July 1st. So if you see the balance sheet, the equity had increased by 2 lakhs, debt or bank loan has increased by 3 lakhs, and on the asset side, cash has increased by 5 lakhs. Transaction 2 is the company purchases raw material for 50,000 on July 5, promising to pay the money by end of the month. On July 5, if you see the balance sheet, the raw material stock has increased by 50,000 and the creditors balance has increased by 50,000. Transaction 3. The company hires workers and it agrees to pay 80,000 by end of the month. By July 15, workers had completed half of the work. Therefore, if you see the balance sheet on July 15, the raw material stock has decreased by 50,000 and the work in progress increased by 50,000 plus half of the wage, which is 40,000, equal to 90,000. And the asset side, liability side, accrued wages had increased by 40,000. Transaction 4. By July 30, the work has been completed fully and the wages were paid and the creditors were also paid too. So on July 30, if you see the balance sheet, the work in progress had decreased by 90,000 and the finished goods had increased by 1,30,000. On the liability side, accrued wages had decreased by 40,000, creditors had decreased by 50,000, As a result of all of these transactions, the cash had decreased by 1,30,000 rupees. Transaction 5. By account August 01, finished goods had been sold for 1,50,000 rupees on credit to be paid by the customer by mid of the month. As a result of which, if you see the balance sheet on August 01, the finished goods had decreased by 1,30,000. Receivables had increased by 1,50,000. And on the liability side, the retained earnings had increased by the profit 20,000. So sales is for 1,50,000. If you see the profit and loss statement, the sales is for 1,50,000. Cost involves the raw material and wage expense. Raw material is 50,000 and wage is 80,000. So totally it is 1,30,000. So the profit is 20,000. So which is the retained earnings, which has been put in the balance sheet, liability side of the balance sheet. Transaction 6. By August 15, receivables were paid and 20,000 was paid towards debt part payment. So on August 15, if you see the balance sheet, the receivables had decreased by 1,50,000, cash had increased by 1,30,000, and the bank loan has decreased by 20,000. The raw material was purchased on July 5, that is transaction 2, and the supplier was paid on July 30, that is transaction 4. So the total number of days taken to pay was 25 days. Therefore, the accounts payable turnover ratio is 365 divided by 25, which is 14.6. Raw material was purchased on July 5, that is transaction 2, and sale was made on August 01, that is transaction 5. So the total number of days the raw material was inside the company was 27 days. So the inventory turnover ratio will be, that is 365 divided by 27, which is 13.5. Sale was made on August 01, which is transaction 5, and the customer paid on August 15. So the total number of days taken by the customer to pay was 14 days. Therefore, the debtors turnover ratio will be 365 divided by 14, which is 26. You can watch the other videos in this channel about inventory turnover ratio and debtors turnover ratio for further details on what and how of inventory turnover and debtors turnover ratio.